we always get the question, what makes a great founder? So great founders that we've seen are not just visionary, but they're adaptive. And I think that's even more important in today's world where the pace of technological change is so fast. Between the day you start and a few years, AI and everything is just changing the speed cycle. And so the teams that can respond to changes in regulation and market and capital, they tend to do really well.
Hello, everyone. My name is Vinay. I lead investor partnerships for EMEA at Tracxn. Thank you for joining my podcast with VCs. Through this series, I speak with leading VCs in the UK, how venture capital is evolving and where the next generation of transformative companies will come from is what is going to be discussed in this series. Today, I am delighted to be joined by Kevin Simmons, General Partner at LoftyInc Capital, a leading early-stage venture firm based in the United Kingdom and backing technology-driven companies across UK, Africa, and globally. LoftyInc has been at the front end of supporting founders building solutions for the everyday economy with a strong track record of backing high-impact startups across fintech, enterprise, and infrastructure. The firm has also played a key role in supporting some of Africa's most prominent technology companies. Kevin brings a truly global perspective with over 20 years of experience across the energy sector, entrepreneurship, and venture capital. He has been involved in more than 100 technology investments across Africa, the US, and Europe, and has backed category-defining companies such as Flutterwave, Andela, and Wave. Kevin, it's great to have you with us today.
It's an absolute pleasure, Vinay. Thanks for having me.
Great. Now let's start with your career journey and investment lens. You've now been involved in over 100 technology investments globally. That's a phenomenal achievement. What patterns have you consistently seen or held true across markets?
That's a great question. If I think about it, and again, across the US or the UK, wherever, I think there are three things that I see consistently. And one is, and it's often referred to, but the best companies are usually really solving a recurring real pain point. Okay, they're not just some conceptual idea. There's something that needs to be fixed, and it allows people to be really dedicated to fixing them. And the founders that are closest to the customer and really deeply understand the problem, they tend to outperform. I think another pattern that we've seen is that we always get the question, what makes a great founder? So great founders that we've seen are not just visionary, but they're adaptive. And I think that's even more important in today's world where the pace of technological change is so fast. Between the day you start and a few years, AI and everything is just changing the speed cycle. And so the teams that can respond to changes in regulation and market and capital, they tend to do really well. And I think the third things, so the capital helps, but really the quality of leadership really matters. So whether we've seen this in the US, we've seen it across Africa and even in Europe, but companies scale when founders are able to match operational rigor with their ambition. And so the market may shape the path a bit, but leadership quality determines the outcome. Those are the three most important factors that we found at this stage.
Great. Having invested across Africa, US, and the UK, what differences stand out most in how companies are built and scaled?
I would be honest, the thing that kind of separates the businesses we back in Africa, and we are largely focused on Africa and some of the other markets, is speed of execution, the possible speed of execution. And here's why. Because it takes a lot longer in Africa and what we call high friction markets. The biggest difference is that in Africa, companies have to build often both the product and the market at the same time. There's not always the same easy infrastructure for distribution or payments. And so quite often you're building your core product, but having to build systems alongside it. In the US and the UK, quite often founders can just plug into existing infrastructure, whether that's in logistics or payments or identity and distribution. And it makes it so much easier to execute or so much quicker. But I will say that in Africa, because the companies have to compensate for a somewhat weaker infrastructure, we find that it makes African founders incredibly resourceful. So they tend to be more capital efficient, more resilient, and really, really inventive on the operations side.
Right. It's a very good point, that speed of execution. I think that's something that every founder should inculcate. Now, coming to Lofty's thesis and backing the everyday economy, LoftyInc talks about backing startups solving problems in the everyday economy. How do you define that? And why is it such a compelling investment theme for you?
So at Lofty Inc., we always say that the everyday economy is about the sectors and services that people rely on every single day. It's how they pay, how they move, how they buy, how they sell, how they save, how they communicate, access healthcare, run small businesses. And if you understand the nature of African economies, these are not niche behaviors. They're very high frequency and they're mission critical parts of life. So if you're deploying capital into what many might perceive as a high risk environment, you want to put your capital where there's going to be activity. People are going to be eating, they're going to be buying education, so it tends to be right down the middle of what we call the everyday economy. And we see when you solve a problem in the everyday economy, you're really addressing a large market with consistent demand. And that's necessary where purchasing power may not be the same as it is in the US, et cetera. So you need to know that people are going to return every day and buy their airtime or whatever it is. So you need that volume of numbers, even though the ticket price may be small, that builds to a really investable thesis.
Excellent. Now, moving on, many global investors often overlook these segments, right? What are they missing when they don't pay attention to these markets?
Well, that's a great question. I think the first thing that we know that global investors don't automatically get is the scale of these often informal or hidden markets. There's no easy Google search you can find to understand how much people are buying of flour because it's distributed through very informal channels or bread. So these markets may not look neat on paper, and people assume they're too difficult or too small, but in reality, they're generally massive. They're just poorly measured and usually very under digitized. But what the investors miss is that some of the best opportunities sit where friction is greatest. So, and if millions of people and businesses are already transacting in these informal ways, the companies that are able to formalize that or digitize that or structure that activity can create enormous value.
Mm-hmm. That's very well framed. Now, your recent investment in Fafor highlights the idea of a graduation gap. Can you explain what that gap is and why it matters for the African ecosystem?
Yes. So Wafer is a fintech, a business in Morocco that we're very excited about. And it was one investments that we led from our most recent fund that we've just closed. And so the concept of a graduation gap is really the space between, the time between proving that a business works and becoming institutionally investable at scale. Some people talk about seed to Series A, but it actually occurs at different places. It's really when it starts to work and when it can become investable by the people that will take it the rest of the way. It's important because a lot of startups can show traction, right? Early customers, even revenue, even in the African market especially. but they struggle to graduate to the next level into the kind of company that larger pools of capital can back confidently. And that's why we're really trying to address this graduation gap in our firm. You see, that gap exists because it takes scaling requires more than just product market fit. It needs systems, it needs governance, it needs the right talent depth, it needs reporting discipline, and even a real focus on the finances and the unit economics. So, many founders are building in environments where those things aren't automatic and those support systems are not readily available. And that's what we're attempting to do a lot with the business like Waffer and other businesses, is help them get across from when we know their work, we see a lot of people build in, buy in, and then when they become really commercially attractive to institutional investors. That's where we want to be most supportive.
Great. Now, I think that's a very well framed answer on the graduation gap. And building on that, like, I'd love to zoom out into Africa's venture ecosystem, reality versus perception. Like, funding cycles in Africa have evolved significantly over the years. What structural changes are you seeing in how capital is deployed today?
Yeah, great question. So LoftyInc, we were one of the, I would say, among the earliest kind of VC organizations of its kind. So we've been 14 years, I think, or maybe 15. What we see today is there's really a move away from what you might term growth at all cost, the willingness to invest despite seeing all the full picture. And there's a move towards much greater capital discipline. As an investor today, and it's not just us, it's across the market, we do want a clearer line of sight to high quality revenue, not just, we want to know how's that revenue coming and can it be sustained? We want to understand the margin structure of the business, because at the end of the day, a business without margins is going to struggle at some point. We want to understand that there are credible paths to profitability. But what we're also seeing is there's more segmentation in the market. That means, like, not all capital behaves the same, and there are different types of capital now available in the African ecosystem. There's debt, there's mezzanine, there are blended types, there's the equity that we provide. Some investors still remain willing to back the bold early stage bets, and we need that. But later stage capital has become more selective and more demanding on governance and performance. Us ourselves, we began very early stage and we're still there, but we too have become more demanding on governance and performance. And I think most importantly, however, I think there's a growing recognition among the African VC community, and we're all very close and we talk quite a lot, is that African venture can't simply mirror Silicon Valley playbooks. Capital deployment, I think, more and more has to reflect local realities, longer timelines, and more operational intensity. There's just more that has to happen, and the need for businesses that are resilient and not just fast growing. So it doesn't help anyone to grow a business so fast that it dies. So we're looking to also understand, can you build a resilient business? Those are the big changes in how capital is moving in the African venture space.
Well, very thoughtfully framed, especially the shift toward clearer segmentation and how expectations evolve as you move into later stages. It also highlights the role of early stage investors like LoftyInc Capital have played in building the initial foundation, even when the ecosystem was far less mature. Now, moving on, you've mentioned that talent is evenly distributed, but opportunity is not. What needs to change structurally to unlock more consistent outcomes across the continent?
Absolutely. What really needs to improve is better jockey training. What I mean by that is, we always say invest in, there's the racetrack, the market, there's the horse, which is the business, and the jockey, the founder or the senior team. We need stronger support structures around talent. That means, more local capital, more founder development, better managerial pipelines, a greater talent depth. It's one of the advantages that certain ecosystems like Silicon Valley have in abundance. They have a lot of people that have been involved in it for a very long time and have relevant experience and can bring it to bear because they've worked out this company or this company, and they bring those lessons and skills with them. So that's definitely one. I think too often, though, in the African space, there's great talent that exists, but it's in ecosystems where the capital is thin and experienced operators are scarce because we're still in what we call day one. We've only been doing this for 10 years maybe. And so it's not as easy to find, oh, here's a guy that, built this tech business for 30 years and exited and sold it and built another one. And so founders have to look much harder to find that. And so the talent exists, but the ecosystem has to support it quite a bit more. And so if we can build better bridges between our local ecosystems and that global capital and global talent insight, better storytelling, stronger investment readiness, stronger founder capabilities, I think we're going to see the results in our market very, very quickly.
That's a very powerful point, especially around the gap in experienced operators. It really highlights that building successful ecosystem isn't just about capital, but about compounding knowledge, mentorship, and execution experience over time. Especially places like Silicon Valley have benefited from for decades, I think now. Now, moving on, the sector insights where opportunities emerging. So across your portfolio and pipeline, which sectors are you most excited about right now?
So our excitement stems from a kind of a foundational view we have of African markets. I'm sitting talking to you from Uganda. I'm flying to Nairobi, to Kenya in a minute, and we spend a lot of time. I'm in Ghana next week. And when you understand these markets, at its heart, Africans are traders, okay? And so what you need to trade is the ability to move money for the goods and services that are moving. So we're very excited by fintech and financial technology. But on top of that, you still need the ability to move the goods and sometimes the services. And so supply chain solutions and transportation, Africa's a big continent with big distances. So getting things moving, there's a lot of effort to do that. So that also excites us. But also just for that to happen, you need an educated, healthy, well-fed workforce. And so areas like, healthcare, food and agriculture, those things as well require that. But overall, we're very excited by what we call SME enablement, so small and medium businesses. Africa has a larger percentage of their economies made up of small and medium businesses, as opposed to many ecosystems in the West, where you have very large companies that employ hundreds of thousands of people and have large systems. Africans' economies are made up of smaller. So fit for scale enterprise tech is also quite exciting. And probably the other thing that's really come into our consciousness of late, outside of, as I said, fintech, logistics, embedded commerce, it would be climate-linked infrastructure. We've seen in the last 5 years that climate is no longer a conversation just happening in upper investment circles or in policy think tanks, but now we're speaking to founders and small businesses, and they're aware of how climate is affecting them. So that's also, that kind of consciousness at a mass level provides an opportunity.
Great. That's a great mix. And it really reflects how the opportunity in Africa is being shaped by very real everyday needs, from financial services to supply chains, healthcare, and education. Now, moving on, fintech has historically dominated African ventures. Are we moving beyond that, or does it really remain the core backbone of innovation in Africa?
So that's a great question. So look, fintech still remains foundational because payments and financial access, they're deeply connected to everything else in the economy. If people can't borrow or pay or insure something or save or transact efficiently, many other sectors can't scale properly. But that said, I do think we're moving into a broader phase. And the real opportunity we see is not fintech in isolation now, but it's what we call embedded fintech. So fintech embedded into commerce, into logistics, into agriculture, into healthcare, mobility, or even enterprise operations. So how you can help certain sectors do their business, but know that money still has to move to enable that. So fintech remains central, but increasingly, as that it's increasingly, I think, infrastructure and not as a standalone category. And so we are seeing innovation now in other sectors beyond fintech.
Great. Now, moving on, actually, that's a very clear way to put it. Fintech, not just as a category, but as the underlying infrastructure powering multiple sectors like mobility and logistics. Now, moving on, you've also been able to uh, you've also been actually close to infrastructure plays like payments, logistics, and mobility. Where do you see the next layer of value creation happening within these?
So I think that's, well, for us, it's fairly clear. Obviously, every investor has a different focus or they see things differently, but we see the next layer of value creation in orchestration and intelligence. Okay. Well, let me explain what I mean by that. The first wave, and some people think it's still being built, but the first wave built the rails, payments, movement access, connectivity. The next wave is really about making those rails work together more efficiently. So
Mm.
we are interested in companies that sit at the coordination layer, businesses that improve routing, utilization, working capital efficiency. Whereas before the rails were, can we get working capital to businesses? And now that's happening. Now, can we make that working capital move around more efficiently? Merchant intelligence. We were just looking at a business yesterday that was on fleet economics and supply chain visibility. So that coordination and intelligence layer is where we see the next winners coming from. So once the infrastructure has been built, we think the companies that make that infrastructure more productive are going to extract a lot of value.
Very well framed. Now, Kevin, let's talk about founder evaluation and scaling in emerging markets. When you meet founders building in Africa, what separates those who successfully scale from those who struggle?
Wow, it's a great question. I'm a bit of a sports fan, and I'm going to age myself. I go back to the Michael Jordan years, the Bulls type of stuff, and I'm probably going to lose half your audience. But the founders who scale combine three things. It's a bit like what Michael Jordan did. They understand the game really well, so we call that deep customer insight. They have strong execution ability. They can execute. Like Michael could play. Okay, he could execute any type of shot in any situation, and the ability to attract talent around them, because no one founder builds a really scalable business. The ones that, as you said, what separates people that successfully scale from those who struggle is the ability to get other A players or other talent around you. So I think those three things: deep customer insight, strong execution discipline, and the ability to attract talent around them. And perhaps one more that kind of covers all of it is focus. The strongest founders know what their wedge is. They know what they want to do and what they're not going to do. And that really matters when it comes to driving metrics, etc. They're able to stay ambitious without becoming distracted. And the ones that struggle, it's not that they lack intelligence or drive, but sometimes we see that they try to scale businesses before they're operationally ready, or they raise capital around a story rather than fundamentals. And so scale comes from just those things: deep customer insight, execution, and getting people to work with you who are really good.
That's a very strong combination, I must say. Um, Now, moving on to the next question, what is one mistake you consistently see founders make when trying to raise capital from global investors?
Yeah, we're seeing this more and more. So that's one thing. I think probably the most common mistake that founders make is the way that they pitch the market opportunity. When it's pitched in a way that's too abstract or not sufficiently investable, it makes it difficult for investors. So they may be describing a large problem, like, everyone needs to breathe, so I'm providing oxygen. But if they don't clearly show how they can capture value efficiently and scale it, and why their model really works at this stage, it makes it hard. You see, global investors, and we consider ourselves somewhat global. We've done deals in many markets. We need more than just a compelling mission. That has to be there, but We want evidence of repeatability. Venture model works when something can be done over and over and over. We need strong unit economics because businesses have to be healthy, and ideally you want that business to grow as much from its own fuel as yours. And really, one thing that I this is my own pet peeve. I'm always pushing founders to talk about how they're going to acquire customers. So we really credible ways of acquiring customers. That logic is important because then I have the business that I have the confidence that a business can absorb capital efficiently. If you know where to find your customers and how to get them, that's what I'm looking for. I usually use the scenario of a beer seller in a big stadium. You know, if you go as a beer seller to each and every person in turn over the 90 minutes of a football game and say, "Do you want a beer? Do you want a beer?" You're not going to sell that many because a lot of people aren't going to. If you're prepared to make yourself really visible and yell and have people raise their hand, you're going to know right away who wants some beer, and you can just throw it to them, and you're going to sell the most beers that you can sell. So acquiring customers is the most important thing to get that kind of hyper growth going.
Great. Now, to conclude, LoftyInc is known for being deeply involved with founders. Beyond capital, how do you support companies navigating complex markets and scaling challenges?
Oh, that's a great question. And I lead the practice at the firm that deals with what we call our post-investment support. Having been a founder myself, and I've worked with a number of startups, and they haven't all been great at all. And having one small exit in the UK, we bring a lot of that focus to businesses. Beyond capital, we try to help our founders think through strategic decisions. We always say that the only thing that we're really buying from the time we write a check to you to the time that you hopefully write a much bigger check back to us is the cumulative impact of all the decisions you make. Okay, who to hire, who to fire, when to chase one opportunity, how ethical you will be. Like once we're on board, we are linked to your decisions. So we try to help them think through strategic decisions. We try to add value in the talent area in Africa. That's important, and also kind of governance and partnerships, fundraising. I would say a big part of our role is helping founders build what we call institutional quality very early. Okay, stronger reporting, sharper board discipline, better capital strategy, how to use your money, when to get working capital, when to get debt, but then also really around growth. At the end of the day, we're in a growth business. So we spend a lot of time trying to learn ourselves. How do you grow quickly? What are the tools? What are the tools that work in Silicon Valley? What are the growth hacking techniques? How can you get customers even faster and faster? Where can you build a growth loop? So ultimately, the goal is to help companies move from being promising to being very durable and then very fast growth. And in complex markets, that is very hands-on. It has to be very hands-on.
Great. Kevin, that was a fantastic conversation. Thank you for sharing such thoughtful and grounded perspectives. What really stands out is how you framed the African venture ecosystem, not just an emerging opportunity, but as one that is steadily maturing from early conviction-driven investing to a more structured and segmented capital environment. Your insights on the graduation gap, the importance of ecosystem support, and the role of fintech as a foundational infrastructure really bring clarity to where market is today and where it is heading. I also think your emphasis on founders, particularly around deep customer understanding, focus, and execution, is a powerful reminder that regardless of geography, great companies are ultimately built by exceptional people. Thank you again for joining us, Kevin. It's been a real pleasure having you on our show.
Thank you, Vinay. Pleasure. Take care. Good luck, everyone.